Hey, you ever wonder how much money the United States government owes? As in, how much is that? Well, if you don't wonder about that, you should. We're going to tell you all about it right now. The United States has a debt of nearly $33 trillion. Yes, with a T now. Economists will tell you that some of that is held by Social Security and other government programs. But that doesn't mean you can just ignore the rest of it. Carrying a large debt can be a problem, can lead to financial crises. Ask yourself this: does the United States government have any money? No. Oh, they must be rich. Well, they are, but not in cash. They're rich in promises to pay. What's that worth? Well, a lot of people want to bet on those promises. There's a place where you can do that. It's called the bond market. Welcome to the UD bond market. Here, investors from around the world come to buy pieces of paper that promise to pay you back with interest. That's right. You lend your money to the federal government and you get paid back with a little bit extra. The best part, it's incredibly safe. In other words, it's almost risk-free. The US government doesn't like to default on its debt. If you lend money to someone else, there's always a chance that they might not pay you back. But with the US government, well, it's different. There's no chance. They may be broke, but they'll find a way. So what's the catch? Well, the only catch is you've got to be careful which bonds you buy. See, the US government issues all kinds of bonds. Some pay higher interest rates, others pay lower ones. The ones that pay higher interest rates are riskier. Why? Because when you lend money to the US government, you're trusting that they'll be able to pay you back in full. If there's any doubt about that, you'll get a higher interest rate. When the government borrows money, it needs to be attractive to investors, so they offer better rates. The most basic bond you can buy is called a treasury. These are the safest of all. The government itself guarantees them. The interest rate is set when you buy the bond. Say you buy a 2-year treasury at 2%. For 2 years, you're guaranteed to receive a 2% interest rate. Treasuries are available to everyone. Anyone can go to the government and say, "Hey, I want to lend you some money." Great, we'll pay you back with a 2% interest rate. Now, if you want to take a slightly bigger risk, you can buy a treasury, inflation-protected security, or TIPS. These bonds adjust to inflation. So if prices go up, so does your interest rate. That helps protect you from inflation. A third type of bond is called a treasury note. These are medium-term bonds with maturities ranging from 2 to 10 years. Like treasuries, their interest rates are set when you buy them. Finally, there are treasury bonds. These are long-term bonds, with maturities of more than 10 years. All these bonds are considered incredibly safe. After all, they're backed by the full faith and credit of the US government. But recently, something weird has been happening. Interest rates on these bonds have been going up. It's unusual for long-term interest rates to exceed short-term ones. That's exactly what's happening. Here's why that matters. When interest rates rise, the value of existing bonds falls. That means if you hold a bond and interest rates rise, your investment loses value. So if you bought a 10-year bond at a time when interest rates were low, but then interest rates rose, you would lose money on that investment. So here's the big question. Why are interest rates rising? Well, it all comes down to one word: inflation. When inflation is high, the Federal Reserve typically raises interest rates to bring it down. That means the federal funds rate, the interest rate that banks charge each other for loans, rises. When that happens, so do yields on Treasury securities. Investors demand higher yields on their investments. So if you lend money to the government today, you want a higher interest rate than you would have gotten 5 years ago. The higher the inflation rate, the higher the interest rate. You may think that it's good that interest rates are rising. After all, it shows that inflation is cooling off. But it also means that the government is paying more money on its debt, and that adds to the deficit. In other words, the more money the government pays out in interest, the more money it needs to borrow. And that means even more debt. The government could try to reduce its debt by cutting spending or raising taxes, but so far, neither of those things have happened. Instead, the government has just kept borrowing more money. Here's the problem. If investors lose confidence in the government's ability to pay back its debt, interest rates could rise even further. That could make it even more expensive for the government to service its debt, and that could lead to a crisis. So far, though, there's no sign of that happening. The US debt market is still considered to be incredibly safe, but that may not always be the case.